You have no trust fund, no family property coming your way, no parent who can make a phone call and land you a corner office. Your financial education was watching someone stress over the electric bill every October. Every finance video you have seen features a guy in a rented penthouse telling you to invest in index funds. With what? This is 10 financial tips ranked from the one everybody already repeats to the one nobody tells broke people. Most obvious first, most effective last. And at the end, a closing piece of advice from a man who was homeless and ended up a billionaire without borrowing a single dollar from family. Oil money, banking dynasties, restaurant chains, property development, all of those require capital you do not have. These 10 do not. The first one, and you already know it is coming, is making a budget. A budget is the most repeated financial advice on earth. It is also the least effective on its own. Tracking where your money goes does not create more money, but it shows you the gap between what you think you spend and what you actually spend. The Bureau of Labor Statistics tracks real household spending through the Consumer Expenditure Survey. Behavioral research consistently shows people underestimate their discretionary spending by a wide margin. On a median household income of about $80,000 a year, that gap adds up fast. That means $200 to $400 a month disappearing into stuff you did not plan to buy. You do not need fancy software for this. A free app works. YNAB has a 34-day trial. Every dollar has a free version. A Google Sheets spreadsheet costs nothing. YNAB reports that new users save an average of $600 in their first 2 months. The trap is not starting a budget, but maintaining one. People track expenses for a week, feel responsible, then stop. A budget you do not update is a diary entry. The other trap is cutting so aggressively you have zero fun money. You burn out and then blow $300 out of spite. Keep it honest. Keep it loose enough to survive. A budget is the foundation, but a foundation is not a building. Good. You know where your money goes. Step 2 is making sure one bad month does not erase everything you learned, and that means an emergency fund. An emergency fund keeps you from going into debt the next time your car breaks down. The Federal Reserve puts out a report every year called the Survey of Household Economics and Decision Making. In 2023, 37% of Americans said they could not cover a $400 emergency with cash or its equivalent. So a $400 car repair sends more than a third of the country to a credit card or a payday lender. Your first target is $1,000, then 3 months of essential expenses. You put this money in a high-yield savings account at an online bank, not your checking account. If the emergency fund sits next to your spending money, then it will disappear into groceries and gas by Tuesday. Ally Bank, Marcus by Goldman Sachs, and Capital One all pay between 4 and 5% annual percentage yield right now. That is real interest on your safety net. FDIC insurance covers up to $250,000 per depositor per bank, so the money is protected. You do not need $500 to start. You need $20 and a recurring automatic transfer. Every Friday, $20 moves. In a year, that is over $1,000. The trap is waiting for a windfall. The windfall is not coming. Start with what you have. Now you have a budget and a cushion. But if you are carrying high-interest debt, that cushion has a hole in the bottom. So the third tip is paying off debt. And most people get the strategy backwards. There are 2 methods. The Avalanche method attacks the highest interest rate first. The snowball method attacks the smallest balance first. Mathematically, the Avalanche saves more money. Behaviorally, the snowball works better because you get a win faster. Research published in the Journal of Consumer Research found that people who focused on paying off small balances first were more likely to eliminate their total debt because early wins kept them going. Pick whichever one you will actually finish. The Federal Reserve reports the average credit card interest rate is over 21% APR right now. A $5,000 balance at that rate, paid at minimums, takes over 15 years to pay off. You will pay more in interest than the original balance. The move is simple. Pick one debt and send every spare dollar to that one. Pay minimums on the rest. When the first one dies, roll that payment into the next one. The trap is paying off the card and then using the card again. If you do not freeze it or close it, then the open credit line sits there like a door you left unlocked. The other trap is paying a debt consolidation company 15 to 25% of your enrolled debt. The FTC regulates those companies for a reason. Most of the time, you can negotiate with creditors yourself for free. Once the high-interest debt is gone, the money you were sending to credit card companies is suddenly free. The question is where to park it, and the answer is not your regular bank. Tip 4 is opening a high-yield savings account. If you already did this for your emergency fund, good. Use the same account or open a second one for different goals. If your savings sit in a traditional bank, then you are earning roughly 0.46%. That is the national average, according to the FDIC. A high-yield online account pays 4 to 5% on the same money with the same federal insurance. On $5,000, that is the difference between about $23 a year and $250. It takes 10 minutes to open, with no minimum balance and no monthly fee. Ally, Marcus, Capital One, Discover, SoFi, take your pick. Bankrate publishes updated rate tables every week if you want to compare. The trap is chasing the highest rate and switching banks every 2 months. The difference between 4.3 and 4.6% on a small balance is pennies. Pick one, set it up, and move on. A high-yield savings account is not an investment. It barely keeps pace with inflation. Think of it as a better parking lot for cash you need within the next year or two. Your money is now in a better account earning real interest. But 4% will not build wealth over a lifetime. What will is investing. And most broke people think investing is only for people with thousands to spare. Tip 5 is how to start investing with little money. You can buy fractional shares of an index fund for as little as $1. A single broad market index fund like Vanguard's Total Stock Market Fund gives you a tiny piece of every major company in America. The ticker is VTI, and the expense ratio is 0.03%. That means for every $1,000 invested, you pay 30 cents a year in fees. Fidelity, Charles Schwab, and Vanguard all offer zero commission trades with no account minimums. You open the account online in under 15 minutes. According to historical data compiled by Aswath Damodaran at NYU Stern, the S&P 500 has returned an average of roughly 10% per year since 1928. If you invest $50 a month starting at age 25 and earn an average of 8% annually, then standard compound interest puts you at roughly $174,000 by age 65. $50 a month, not $500. Gallup's annual Economy and Finance Survey finds that roughly 62% of Americans own any stock at all. The other 38% are not even at the table. Your brokerage account is protected by SIPC insurance up to $500,000. The trap is panic selling. Markets drop 20 or 30% sometimes. They have done this roughly every 7 to 10 years for over a century. If you sell during the dip, then you lock in the loss. The entire strategy of index investing relies on you doing nothing when things look scary. The second trap is stock picking or day trading. Statistically, most retail traders lose money. Buy the whole market, add money regularly, and do not touch it. Investing on your own is powerful, but there is a version where someone gives you free money to do it. Tip 6 is understanding your employer's 401k match. If your employer offers a match, then they put free money into your retirement account for every dollar you contribute, up to a limit. The most common formula, according to Vanguard's How America Saves report, is 50 cents on the dollar up to 6% of your salary. If you earn $40,000 a year and contribute 6%, that is $2,400 from your paycheck and $1,200 free from your employer. That is a 100% return on that $1,200 before the market does anything at all. A significant share of employees who have access to a match do not contribute enough to get the full amount, which is free money left on the table. Your 401k contribution also reduces your taxable income. If you are in the 22% federal bracket and contribute $5,000, then your tax bill drops by about $1,100. The IRS sets the annual contribution limit at $23,000 for 2024 if you are under 50. You enroll through your company's HR department or benefits portal. The trap is cashing out your 401k when you change jobs. You pay income tax plus a 10% early withdrawal penalty if you are under 59 and a half. Roll it into an IRA instead. It takes one phone call. So far, every tip has been about managing, protecting, or slightly growing money you already earn. Tip 7 is about tax credits and deductions for low-income workers. If your income falls below certain thresholds, then you may qualify for the Earned Income Tax Credit. The maximum for tax year 2024 is $7,830 for a family with 3 or more qualifying children. Even a single filer with no kids can get up to $632. This is not a deduction that slightly reduces your tax bill. This is cash the IRS sends you directly. About 1 in 5 eligible taxpayers does not claim the EITC, according to IRS data. That is billions of dollars going uncollected every year. There is also the Savers Credit, which gives you up to $1,000 for contributing to a retirement account if your income is below certain thresholds. The Child Tax Credit is worth up to $2,000 per qualifying child under 17. You claim all of this by filing your federal tax return. IRS Free File is available to anyone with an adjusted gross income at or below the annual threshold, which has been $79,000 to $84,000 in recent years. It costs $0. The trap is paying someone $200 to $400 to file a simple return you could do yourself for free. If you have straightforward W-2 income, then Free File, or a basic version of TurboTax, handles it. The other trap is fear. People with simple returns avoid filing because the process feels intimidating. That fear costs them thousands of dollars a year in unclaimed credits. Tip 8 is about building credit with no credit history. A credit score is not about being in debt. It is about proving you can borrow and repay on time. The Consumer Financial Protection Bureau estimates roughly 26 million Americans are credit invisible, meaning they have no credit file at all. Another 19 million have files too thin to score. If you are one of them, then landlords turn you away and auto loans cost you more. Sometimes even employers check your credit. The fastest entry point is a secured credit card. You deposit $200 as collateral, and the bank gives you a $200 credit line. You use about 10% each month, that is $20, and pay the full balance every month. Discover's secured card has no annual fee and reports to all 3 bureaus. In 6 months of reported activity, you generate a real FICO score. The average FICO score in America is roughly 715, according to Experian data. Getting above 700 means lower interest rates on every major purchase for the rest of your life. The trap is treating the credit card as spending money. The card has one job, and that job is to build a history of on-time payments. Buy one small thing a month, like a streaming subscription or a tank of gas. Pay it off and put the card away. The moment you carry a balance, interest eats the benefit. Now your score is climbing, your debts are falling, and you are collecting every credit you qualify for. All of that is good, but there is a hard ceiling on it. You cannot budget your way to wealth. Tip 9 is about increasing your income instead of just cutting expenses. There is a floor on how much you can cut, because you cannot spend less than zero on entertainment, but there is no ceiling on how much you can earn. The fastest path to more income is either negotiating a raise at your current job or adding a skill that pays on the side. Surveys consistently show that a large share of workers never negotiate their salary at all and just accept what they are offered. Walking into that conversation with salary data from the Bureau of Labor Statistics Occupational Outlook Handbook or from Glassdoor makes the difference between asking for a vague more and naming a specific number with evidence behind it. If a raise is not on the table, then a side skill can be. The Bureau of Labor Statistics reports a median hourly wage in the low 20s for bookkeeping clerks, but independent bookkeepers with their own clients often charge $20 to $50 an hour. You can learn basic bookkeeping through free resources online and land your first client on Upwork, Fiverr, or through cold outreach to local businesses on LinkedIn. If you freelance, then you are technically self-employed. The IRS requires you to pay self-employment tax of 15.3% on net earnings over $400. File a Schedule SE with your return. The trap with extra income is the most predictable one. You earn $500 more per month and somehow your expenses rise by $500. Lifestyle creep is silent and total. The fix is routing the new income directly into debt payoff or investing before it ever hits your checking account. Automate the transfer. If you never see the money, then you never spend the money. That brings us to number 10, the one they teach at the dinner table in wealthy homes and never put in a budgeting app. How to build wealth with no family money. Wealthy families do not just earn more, they own things that produce money while they sleep. A rental property collects rent. A stock portfolio pays dividends. A small business generates revenue whether the owner walked in that morning or not. Broke families buy things that lose value, like a car driven off the lot, electronics on a payment plan, furniture on a credit card. Rich families buy things that gain value or produce cash flow. The Federal Reserve's Survey of Consumer Finances in 2022 found that the top 10% of families by wealth hold the vast majority of all stocks. That is not because stocks are secret. Ownership is a habit passed from parent to child. Home equity is the largest component of wealth for middle-class families. And the racial wealth gap is driven significantly by differences in asset ownership, not just income. The 2022 Survey of Consumer Finances found the median white family holds about $285,000 in net worth. The median black family holds about $44,000. Same country, same economy, different relationship to ownership. The Small Business Administration reports that businesses with fewer than 20 employees account for over 89% of all U.S. businesses. You do not need a warehouse and 50 employees. You need something small that produces cash flow. Your first income-producing asset might be $200 in a dividend index fund from Tip 5. It might be a $500 service business from Tip 9. The amount does not matter yet, but the direction matters. Every dollar you earn has two possible lives. It can buy something that costs you money next month, or it can buy something that pays you money next month. The most important financial shift is to stop asking whether you can afford something and start asking whether the thing pays you back. The trap here is serious. Do not buy an income-producing asset with debt before you can handle the carrying cost. People buy rental properties with no reserve fund, and one broken furnace puts them in foreclosure. Do not buy an asset until you can survive 6 months of that asset producing zero income. Your personal car is not an asset. Your primary residence, if it costs you money every month and does not produce income, is not an asset in this context. Rich parents teach this distinction before their kids turn 16. Nobody else teaches it at all. Now for the closing advice. John Paul DeJoria grew up in a foster home in Los Angeles. He was homeless twice. In 1980, he and hairstylist Paul Mitchell started John Paul Mitchell Systems with $700 between them. DeJoria sold shampoo door to door out of his car. He was living in the car at the time. The company never took outside investment, and it now does over $1 billion a year in revenue. He later co-founded Patron Spirits. Forbes estimated his net worth at roughly $2.7 billion before he sold his Patron stake to Bacardi. In interviews with Inc. magazine and CNBC, DeJoria has said the same thing, that you should be prepared for a lot of rejection, but always have a plan for what you are going to do tomorrow. Here is what you do this week. Pick one tip from this list, not all 10, just one. Open the high-yield savings account. Set up the 401k contribution. File for the Earned Income Tax Credit. Buy $1 of an index fund. Whatever is the single next step that costs you the least effort, do it before the weekend. Then next week, do the next one. You do not need rich parents. You need a sequence, and you need to start it. Everything in this video is general information for education purposes. It is not legal advice, tax advice, or financial advice. Talk to a qualified professional about your specific situation. If this was useful and you want the next one, then subscribe. That is all.